Okay guys, so the GDP report for the second quarter of 2026 just dropped, and the headline number was bad enough, but what's buried inside of this report is what should actually be keeping people up at night. Economists were already expecting a weak number, forecasting GDP growth of 1.8%, but the actual result came in even lower than 1.5%. But here's the thing, the headline miss is almost a distraction from the real story, which is what's happening to American consumers underneath the surface. So guys, with that said, as I get into the details of this video, I ask that you stay with me all the way to the very end, because the single most alarming number in this entire report is not the GDP figure itself. It's buried deeper in the data, and it tells you something really important about how sustainable the current economy is. Alright, so without me wasting any more time, let's dive into the video right now. Okay, so before I get into the scary part, let's be clear on why GDP came in at 1.5%, because the reason matters a lot and it's widely being misunderstood. Most people see a weak GDP number and immediately assume consumers pulled back on spending. But that's not actually what happened here. According to the Commerce Department, there were three primary drivers of the slowdown. First, the government spending declined modestly, and this wasn't some principled act of fiscal discipline. It's because a lot of federal departments are running low on money and simply had to stretch their budgets further, and that reduced one component of GDP. The second thing is, businesses reduced their inventories this quarter, and when companies draw down inventory instead of building it up, that subtracts from the GDP growth. And thirdly, and this is the most interesting and the most misunderstood piece, international trade was a significant drag on the number as well. And here's why that matters and why it's not necessarily as bad as it sounds. Imports subtract from GDP by definition because GDP measures goods and services produced inside the United States. So if you happen to buy a laptop made overseas, it counts as a consumer spending, but not as a US production. So it gets subtracted. And what drove the import surge this quarter wasn't Americans buying more consumer foreign goods. It was businesses like Microsoft, Amazon, Google, Meta, Oracle. These companies were all buying massive quantities of AI chips, semiconductors, servers, and networking equipment manufactured overseas to build out their AI infrastructure. So the imports that hurt the GDP number actually represent businesses investing aggressively in future growth. That is a very different situation from a consumer-driven import surge, and it's an important distinction to understand. So here's where the report gets genuinely interesting. And to be quite frank with you, a little uncomfortable as well. Consumer spending actually accelerated this quarter compared to the previous one. And on the surface, that sounds like good news, right? I mean, consumers make up roughly 2/3 of the entire US economy. So if they keep spending, businesses keep selling, companies keep hiring, and the economy keeps expanding. But I want you to take one level deeper into this report, because what's actually funding that consumer spending is where the real story lives. The Commerce Department also released data on personal income and personal spending for the month of June. Personal income grew by just 0.2%. Personal spending grew by 0.3%. Now that gap might sound small, but think about what it actually means. Americans are spending money faster than their income is growing. And if you're spending more than you're earning, then where is that money coming from? And for most households, it's coming out of their savings. The personal savings rate in America just declined to 2.7%. That is one of the lowest readings that we've had in recent years. And when you look at the chart spanning over the last several years, that downward trend in the savings rate is unmistakable. Americans are not spending because they're flush with cash and feeling financially confident. They're spending by drawing down the thin financial cushion that they actually have left. Now guys, real quick, if this video is giving you any value so far, please show some love by smashing that like button, commenting down below, and subscribing. Your support genuinely helps this channel grow, so please guys, show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's move on to the next segment. Okay, so real quick, let me just spend a minute on this savings rate because I genuinely think it's the most important data point in the entire GDP report, and it's barely getting any attention in the financial media. A 2.7% personal savings rate means that out of every dollar Americans take home after taxes, only 2.7 cents is being saved. Everything else is being spent. And here's the honest, common sense reality of that situation. Savings are not unlimited. You cannot keep drawing your financial cushion indefinitely to fund your spending. At some point, one of two things is going to happen. Either income growth has to accelerate significantly so people have more money coming in, or consumer spending has to slow down because the cushion simply runs out. And if the consumer spending starts to slow down, which makes up roughly 2/3 of the GDP, the impact on the overall economic growth would be far bigger than anything that we saw in this quarter's report. That's why I think that the saving rate deserves so much more attention than the headline GDP number. The GDP miss can be explained by one-time factors like the AI import surge and inventory adjustments, but a personal savings rate of 2.7% is not a one-time factor, guys. That is a structural vulnerability in the American consumer that has been building for months, and it's the thing that could turn a soft growth quarter into something much more serious if income growth doesn't catch up soon. Alright, so now let's talk about the AI investment story, because it's actually playing a dual role in this economy right now in a way that's genuinely fascinating. More than half of all the real GDP growth in the second quarter came from spending on computers, data centers, and information processing equipment and software. Half of the entire GDP growth number was essentially a AI-related investment. On one hand, that investment is supporting economic activity and propping up the headline growth number. Companies are spending enormous amounts of money to build that infrastructure that they need, and that spending shows up positively in the business investment component of the GDP. But on the other hand, because so much of the hardware and the equipment needed to build AI infrastructure is manufactured overseas, those imports are simultaneously dragging the GDP calculation lower. So AI is both helping and hurting the GDP number at the same time, depending on which component you're looking at. The broader question, which nobody can definitively answer right now, guys, is that whether this AI investment wave actually generates enough productivity and economic return to justify the trillions of dollars that are being poured into it. If it does, then the investment story ends up being one of the most significant economic drivers in American history. However, if it doesn't, then we have a situation where companies have taken on enormous debt and spending obligations for infrastructure that doesn't generate the returns that they expected. And that unwind would be painful for markets and for the economy. So guys, let me pull all of this together and land on what it actually means for your financial life right now. The economy is still growing. 1.5% real GDP growth is not a recession, but it's growing in an uneven way, propped up on one side by massive AI-driven business investment, and on the other side by American consumers spending down their savings at an accelerated pace. That combination is not indefinitely sustainable. And the honest takeaway for anyone watching this is that if you are one of the millions of Americans with a savings rate near zero or below, spending everything you bring in and then some, you are personally living the macro trend this report is describing. And that makes you financially fragile in a way that could become very painful if income growth doesn't improve, if a job disruption hits, or if consumer spending does eventually slow and the economy follows it lower. The practical response to this moment is straightforward, even if it isn't easy. Build up your savings rate, even incrementally. Going from 0 to 5% matters a whole lot. Going from 5% to 10% matters even more. And every percentage point of savings rate that you add is financial cushion that gives you options and stability when things inevitably shift. So don't let the fact that consumers in aggregate are spending freely making you feel like it's the safe thing to do. Aggregate spending data masks individual financial fragility, and your job is to make sure that your household is not the vulnerable one when the tide turns. Guys, with that said, I really appreciate you watching this video all the way through. Please subscribe if you haven't already so that you don't miss the next updates that I put out. I tend to put new videos out every single other day. And please drop a comment down below and tell me what you're doing right now to protect your savings rate. Guys, I read every single comment that people put out there and I try to respond so that we can help our community as a whole. I want to thank you guys again for watching this video all the way through, and I'll see you guys in the next video.